I think newer investors, especially when they're looking at deal opportunities, they don't factor location enough. And I think they value, let's say they had an apartment complex in a D area, high crime, economic vacancy is really high. So you have people that are staying there, but they're not paying, right? And they'll compare that to, say a B or a C class property in a much better part of town that's way more stabilized. I think that's a big thing that newer investors make a mistake on. They'll be like, oh, I'll buy in a really rough area. And they come to find out how tough it actually is to manage there. A lot more turnover. It's just tenants are harder on properties. So your CapEx is more, your operating expenses are higher. It's just tougher to run. But I think that's probably the most common mistake. The property we're in right now, this checked so many boxes in what we typically look for as our buying criteria. And this one in particular, you look at Omaha, Nebraska, so we have about 1 million population, right? So comparative to the rest of the country, but this is a prime location. This was operating as a hotel. All the units were already done, so pretty much remodeled, move-in ready for the most part. We really liked that, so we could basically turn it from a hotel to long-term and mid-term, short-term rentals. So we're doing kind of a mix of both here. And that'll allow us to run it as a long-term rental property because it's set up really well for it. We already had bedrooms. Most hotels, you're gonna walk in, there's a bed, there's maybe a kitchenette. It's all like in one room, like a studio apartment. This is set up where there are actual bedrooms in a lot of the units. So that's a much easier conversion when you're looking at changing the use from hospitality to residential. And that's what we're excited about here. But we also got into this deal at 80 grand a door, which if you are involved in real estate investing, that's a very common way for people to do kind of initial analysis on property is how much does the per door cost. So 80K a door, and we think we can get the yield up above so where it will cash flow pretty nicely and have a nice room for an equity play too. So I think if we force appreciation, change the use of the property, and then raise the value on the back end, we're gonna have all kinds of opportunities to refinance. It should still cash flow after we do that. So it just added up to so many different things that we like. It all started with the location. Then we got favorable terms on the seller side with some financing to go along with our bank financing. So we had to bring less money down than you normally would if you just bought something for 25% down. So we were able to save money on the front end. It had a value add component to it, change of use, all good things. Location was awesome. This one was kind of unique because we bought this off market, and this is an 80 unit property. It was a hotel. Not normally our buy box, how you would normally call it, but this checked all the boxes for a multifamily investment. And why did this one come available? This was a case where I think the sellers wanted to sell the property, but they didn't want to go out to market and list it. So they didn't want 1 million showings. It's going to be much more difficult to run a hotel when you're having people coming constantly through it. And I think they wanted to go to a broker who had a good network and reached out to investors that he knew could close. And that's the most important thing in a market like this where you get a lot of tire kickers and the market's softened a bit. I think sellers want certainty when they go and they want to put a property out to try and disposition it, get it sold. They want people that can close. And that's why we got the call. We see this a lot owning a hard money lending business. You get investors that want to get into a deal. They go into it with the hopes of remodeling a project, adding value to it, and then either selling it or refinancing and keeping it. What I see more often than probably anything else, a mistake that new investors make is underestimating rehab costs and carrying costs and factoring all of the costs involved with dispositioning a property. If you can get good at estimating rehab costs and good at understanding what market values are, that is the next skill level that it takes to kind of get good at underwriting. But I think the newer investors, they go into a deal and they're like, oh, I can paint the whole thing, flooring throughout, fixtures, remodel the kitchen, remodel the bathroom, and they're like, I can do that for $12,000. No, you can't. You may not even buy materials for that much. So I think that's the biggest disconnect between somebody with a lot of knowledge about construction and the newer investor that goes in and they're looking at prices from 1985.